Welcome to Multifamily Insights. I'm your host, John Casmon, and I want to thank you for joining us for another great episode. We got a great show today. We're going to be talking to Ken Gee. You talked about, starting really in the Cleveland market and then transitioning down to Florida, really because that was more of an appreciating market. What's your strategy exactly? I mean, were you just, buying and holding? What exactly were you doing with your strategy?
Yeah, that's a good question. So our strategy has actually always been the same, and that is we buy BC class. We buy good properties in good neighborhoods, very important to us, that we think we can add value to. So it's a value add business model. And so I love multifamily because it's not a perfect relationship, but the ability of me to drive cash flow and more cash flow to a property, it almost always results in enhanced value, right? So I like that relationship. A lot of asset classes don't have that kind of a relationship. So I love that relationship. So what we do is we build our business plan around that. So we're going to somehow, some way make that property nicer, a better place to live. And therefore, we're able to command a higher rent structure. And then therefore, we're going to leave it better than when we found it. We always try to leave some for the next guy because the world is full of value add investors. And so we typically hold our deals 3 to 5 years. So we go in, we add our value, we prove it, we do our thing, we leave some for the next guy, and then move on to the next one. And that actually serves so many purposes. I mean, it is a very purposeful way to make money, right? We add value. That's how businesses should make money, by adding value. And we also serves our investors really well because most investors, not all, but most investors like to see some turn of their money. They like to know that they put in $100,000 and 2 or 3 or 4 years later, whatever the time is, they're getting back 175, 200,000 plus. They love that ability to say, wow, I did a good job on this investment. It worked. Now they get to decide on whether or not they want to invest in the next deal. And then we continue with that path. So as it turns out, that value add business model really serves everybody in that whole cycle really well, us as well as our investors.
Great points there. And I love what you talked about as far as focusing on cash flow deals and being able to take that cash flow, but also creating the value. And then there's a little nugget you said is that you like to leave a little bit for the next person because the world is filled with value add investors. And I think that's really interesting because a lot of times people underwrite a deal and they assume that they're just going to take it to full stabilization, right? So they're going to renovate 100% of the units. Everything's going to be at market, fully stabilized, and then they're going to sell it at the peak dollar. And you're saying, hey, we like to leave a little bit of an opportunity for the next person so that they can see what they can do to add more value to the project. So I think that was really interesting. When you think about the Cleveland market, which is historically a cash flow market versus Florida, I'm not sure what parts of Florida you're in, but Florida in general is more of an appreciation market with some cash flow. The strategies could differ a little bit, right? Because if you're looking more at appreciation, that's going to be a little bit of a different, valuation, cap rate, business plan than a deal that's focused on just cash flow, primarily cash flow. When you made that transition, what were some things that you had to change in the way you looked at deals or your underwriting or the way you looked at, how you're going to run this business?
Yeah, that is a super insightful question. And I know you know that. When you're buying in a market like Cleveland that's not growing, growing up in this business, the saying was you make your money on the buy. If you don't buy it right, you're toast. You're never going to do well, right? Well, when I went to Florida and I went to these growth markets, when you apply that same concept, it gets difficult because now you're in a very competitive market where lots of people want to buy. Nobody's giving things away. You're not going to steal something from someone. It's just not going to happen. So what I had to do was I actually completely reversed our underwriting process. And I started with, where can I take this thing? And it required a lot more work, actually. We really beat up our rent surveys. We visit not only the property's competition where it is now, but we look at least one tier, if not two. And we say, okay, where is that market above it? what can I do to this property? And when I'm done, where will this property fit into that new rental market that new set of competition that we've created. Now, once we know that, we actually then back into everything else. So we kind of reverse engineer what we're able to pay and how far we're willing to go. I will tell you that although Cleveland is historically a cash flow market, even when we did value add deals in Cleveland, we got a little bit of cash flow, but we have always made 85% of our money on the sell. We just have. It's mostly appreciation. It's especially true in Florida. It was also true in Cleveland, but in Florida, it's really true because when we do a renovation in Florida and we make that, well, here's why. Let me back up. In Florida, everybody knows there's about 900 to 1,000 people moving into Florida every day. It's just nuts the way it's going. Some of those people are wealthy, but most of them are not, right? Well, they're building properties and new communities for those wealthy people. They're taken care of very well. They're not building properties because they can't afford to for the 70-75% of the people that are actually just ordinary, normal people that are moving into the market. So when we take that property and make it nicer and make it really appeal to that ordinary person, that just normal person that moves into the market, we're able to get significant rent increases. It's not uncommon for us to rent at $300, $400, $500 higher when we reposition that deal because it's a great place now. It looks so much nicer. There's all the amenities that you would want that you really couldn't even have in your single family home because you probably couldn't afford to make all that stuff. So in Florida, we're able to use that model, that reverse engineering model, to then become more competitive on the buy. Because when I first started, I thought to myself, man, I'm never going to get anything here because I keep going in with this mindset, this Cleveland mindset. And once I flipped that mindset, I realized, wait a minute, that's not what this market is about. This market runs differently. It operates differently, and it has served us extremely well since we've been there.
Great insight. I appreciate you breaking that down because, you hear these sayings all the time, right? You make your money on the buy. And the context you just provide is really insightful because that's true if you're in a market that doesn't really appreciate that often, right? Or that much, because you do have to buy it right. And buying it right is always important. But, if you're in a market that's going to appreciate and all the data, all the metrics support that more and more people are going there, more jobs are going there, it's going to be very hard to buy it at a number where out of the gate, you're going to make great money on the deal. You're usually going to have to do something. Going back to value add, you have to focus on that value add strategy and then focus on that business plan and what the upside is. I almost think about it like flipping a house. You can buy a rental property, and if the rental property exists and it has a renter, there's a certain number you might be willing to pay for it based on that rent. But if you're going to renovate it and flip it, well, if there's no one living in it, the rental income is zero. So it doesn't mean that the property's worth zero. There's still intrinsic value in it, right? But now you have to go in there and figure out, well, what will it be worth when I'm done with it? What can it be worth? What do I need to do to it? And it is kind of this melding of those two strategies that makes value add multifamily investing so unique. Let's kind of dig a little bit deeper on this point here, because you talked about flipping that model up on its head, figuring out where you could take the property and then determining what you're willing to pay for it at that point. How do you balance kind of, where you think you can still make profits versus what you think is truly worth today? Or are you willing to overpay, as some may say, or how do you balance that?
Yeah, that's a great question. And we've faced that issue all the time. Now, as we're recording this, the market has changed a little bit. Rates are higher. There's fewer buyers. There's actually fewer sellers too, because the sellers, they don't want to sell at a lower price than what they could, right? So over time, we are very, very selective on the deals that we buy, because in a competitive market, there's a lot of people that want to buy that asset. And so there's most of the time, not all the time, but most of the time, somebody is willing to pay more. Somebody's return requirements might be very different than what ours is. They might have money coming in the country from somewhere else. They just want it safe. They don't need any return. They're just happy. There could be 1031 buyers looking for that. They're just trying to protect against paying the tax. So we find ourselves sometimes being outbid by people, and just because of the structure of their capital stack, it is what it is. Now, I will tell you, we've actually changed our business model a little bit to become more competitive. So in the real estate world, when you raise money, you typically syndicate. So that means you go out, you find the deal, you lock it down, you put some of your money down on it, then you work really hard and really fast to raise the money that you need to close that deal. It's a painful process, very stressful if you're the sponsor. The problem is, in hyper-competitive markets like Florida, everybody's syndicating. So you're just one of many, and you're trying to convince the broker, hey, I'm here. I'm better than the other guy standing next to me. I promise. Let me try to tell you how. So that's a hard, right? Usually that's a hard deal. You got to do something to make yourself stand out. So what we did is, a couple of years ago, we said, wait a minute, let's fix this. Why don't we put the money in front of the deal? So go raise the money first, and then go find the deal. We did that. We raised $12.5 million on our first fund. It's a blind pool fund. And wow, the most amazing thing happened. First of all, brokers worked much harder to find us deals because they knew they had a real buyer who really wanted to deploy capital and that has experience. We find that when we were in competitive situations, we didn't have to be the highest bidder anymore, right? Because we stood out. Why? Because of our certainty of close. We eliminated that equity raise risk, and that was huge for us in a competitive market. So we actually changed our business model in terms of the way we operate. The blind pool fund, it's more of a private equity type experience than it is a syndicate. Syndication is more typical for real estate, but the private equity model, when applied to real estate, really gave us a massive advantage. And so that's what we've done now. That's what we do now, and it's incredibly successful in terms of getting deals that other people might not be able to get.
You talked about being vertically integrated and renovating these properties. When we talk about a value add approach, that's obviously the hard part, right? It's one thing to find a deal, which is difficult by itself, but you still got to execute, you still got to operate, you still have to implement it. What are some of the tips you have on renovating the properties and actually implementing this value add strategy?
Yeah, so you're going to come. This is going to surprise you, but I have 5 things that I want people to think about. So the first, and here's what's interesting about this: the first 3 have nothing to do with renovating. So the first thing I want you to do is make sure you've done your in-depth market study. Remember, I talked about changing the way I look at deals, and so that market study is so important because it helps you keep from over improving. People tend to do that. People want to make Taj Mahal out of everything, and you shouldn't necessarily do that. So that's step 1. Do the market study and make sure you understand where your market is, and objectively, where is your property going to fall relative to its competition when you're done. Secondly, figure out what your budget is, and don't be afraid to modify your budget. I can't tell you how many times I talk to sponsors, clients of ours, we do some third-party management, and they will say to me, Ken, I told my investors I was going to do this. I'm going to do this, come hell or high water. And I'm like, time out. Wait a minute. The world's different 3 months later, 6 months later. You know more now, right? You know more. Why have you not been flexible with your plan? And their concern is that the investors will think that they don't know what they're doing. And I'm here to tell you quite the opposite is true. You need to be flexible. Your investors should want you to be flexible, because if the world changes, you should change, and always be making decisions that are going to improve their position and their capital position. The third thing is so counterintuitive. This is the hard one for everybody. And that's when you buy the property, I want you to sit on your hands for 30 days, maybe 60, whatever it is, some period of time. And here's why. So when a value add deal, you go in after do your due diligence, and you've modified your renovation plan 2 or 3 times. And you're, man, I know what to do. I'm just going to do it on day 1. But then you get in and you're running the property and you realize, I didn't know this, or I didn't know that. Boy, wouldn't it be terrible if you spent all your renovation money and now you had this really important issue that you had no money left to fix. And that could be a problem, right? I learned this lesson 15 plus years ago. I did that once. I put my own money in to fix it. But the point is that you don't want to do that. Don't do that to yourself, because you don't need to. Sit on your hands, make sure you understand what's going on, and then say, okay, the plan is right. It hasn't changed, or it has, and you've tweaked it a little bit. Now we can move forward. Then the last two actually have something to do with renovating, and that is use an outside-in approach, right? So think about how people approach a property, the curb appeal thing. I know it's a big saying in our world, but it really matters. I can't tell you how many times people think people live on the inside of their apartment. I'm going to make the inside of their apartment beautiful. And they don't pay attention to the outside. And what happens is, and you know this if you're an operator, I can't get them to come to the front door so that I can open that door and show them that beautiful apartment. So you've got to do outside in no matter what, because that's the only way to get them to the front door. And then the last thing I would say, and I kind of talked about this before, constantly reassess your plan, even when you're in the middle of renovating. When we do this, we tackle first phase of things, and then we say, okay, what's going on? How did that go? Is there any, then we look at phase 2 and phase 3, and we do it very deliberately and slowly so that we're always making sure that we're allocating that capital where it should be. So there you go. As you can tell, I've thought a little bit about this. If you like the content that we've shared here, please be sure to subscribe to our channel and hit the bell. So thank you again, and have a wonderful day.